Welcome to the OXYS Systems Fiscal Year 2014 earnings call. My name is Paulette, and I will be your operator for today's call. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session. Please note that this conference is being recorded. I will now turn the call over to John Cunningham. Mr. Cunningham, you may begin.
Thank you, Paulette. Good morning, everyone, and welcome to OXYS Systems Incorporated Fiscal Year 2014 earnings conference call. With me today is OXYS Chief Executive Officer, Julian Ross, Vice President of Sales, Clark Hood, and outside counsel, David Luther. Before I turn the call over to Mr. Ross, may I remind our listeners that in this call, management's prepared remarks contain forward-looking statements which are subject to risks and uncertainties, and management may make additional forward-looking statements in response to your questions. Information regarding forward-looking statements, except for historical information contained herein, are made pursuant to the safe harbor provisions of the Private Securities Litigation Reform Act of 1995. Forward-looking statements involve known and unknown risks and uncertainties, which may cause our actual results in future periods to differ materially from forecasted results. Actual results may differ from those discussed today, March 31st, 2015, and therefore we refer you to a more detailed discussion of the risks and uncertainties in the company's filings with the Securities and Exchange Commission. Now it's my pleasure to turn the call over to OXYS Chief Executive Officer, Julian Ross. Julian, please go ahead.
Thank you, John. Good morning, everyone, and welcome to our earnings call for financial year 2014. We finished the year strong. We have grown the business once again while remaining focused on building a solid medical device platform to leverage growth opportunities going forward. And now let me get straight into the results. Revenues were $2.4 million, up 35% from last year, led by an 83% increase in revenues in the U.S. The fourth quarter of 2014 was our 10th consecutive quarter of sales growth. Gross margin was 56% on an adjusted basis. G&A expense was $1.75 million. Cash was at $647,000. We completely paid down all of our capital leases. Long-term debt was down 42%. We had a working capital surplus of $418,000. Our current ratio was 1.3. Total assets increased 7% to $2.5 million. Net loss per share for the year was 10 cents. Our Model 615 shipments was up 18%. Replacement cartridges shipments was up 35%, and then replacement cartridges was up 144% of Model 615 shipped. Now, revenues increased by 35% to $2.43 million from $1.8 million in 2013. The increase was primarily driven by an 83% surge in revenues in the U.S. You will notice that our gross profit was just over $1 million for the 12 months ended December 31, 2014, a decrease of 15.7% from $1.2 million the prior year. This change was primarily due to the effect of an increase in absorbed rent expense and labor cost. Adjusted for these labor and rent expenses, gross profit was $1.35 million, representing a gross margin of 56%. For the fourth quarter of 2014, revenue was $585,000, up 9% from the fourth quarter 2013. Gross profit was 9%, or up 9%, and the gross margin was about the same. Now, this slide represents our historical sales trends. The top half of the slide shows our revenue growth for the past 10 quarters. As you can see from the red numbers, this is now our 10th consecutive growth quarter, of which 5 quarters with triple-digit growth and 4 quarters with double-digit growth. The bottom half of the slide shows our revenue growth for the past 3 years. Again, double or triple-digit growth. And we have no intention of slowing down. Now, we have invested in our medical device platform, and we have invested in growth in a controlled way. Starting with G&A, we were up 77% to $1.7 million for the year. The drivers of this increase include an increase in employee stock option expense, an increase in salaries and wages, and an increase in professional fees. Professional fees in particular increased significantly due to legal and accounting fees related to an acquisition we pursued during the second half of 2014, but did not consummate during 2014. We made material investments or reinvestments in sales and marketing and product development, which were up 104% and 64% respectively. Interest expense was also up by 263%, but by far the largest portion of our interest expense relates to non-cash GAAP interest, such as amortization of beneficial conversion features, or BCF, and so on. Adjusted for these non-cash items, interest expense would have been less than $16,000. Overall, we continue to believe that you will be pleased with the returns on these investments in due course. We continue to balance the need for growth and hence investing in growth with the need to watch the bottom line as we grow. Now, when you look at our net loss for the year, we're at $2.7 million or 10 cents a share. But if we did adjust for the non-cash interest and one-time expenses for legal and professional fees related to the acquisition, our net loss was $1.6 million, and the net loss per share was 6 cents. Now for some other financial items. We completely retired all of our leases. That includes Citibank, Dell, Wachovia, NMGH, and others. That means we now own outright all of our machinery and equipment in FF&E, with a total acquisition cost somewhere around $2 million. There are no liens or other obligations on this equipment, and we believe that substantially all of the useful life of the equipment remains. We had deferred income tax assets of approximately $5.6 million for the year ended December 31, 2014, which was offset in full by a valuation allowance. Our balance sheet continues to remain strong. Cash was at $647,000 at the end of the year, as compared to $657,000 at the end of last year. Working capital was a surplus of $418,000. As I mentioned before, our current ratio was 1.3. And finally, cash from financing activities was down 24% to $1.2 million during 2014 from $1.5 million in 2013. As for Model 615, unit cartridge reorder rates continue to increase as the install base of Model 615 increases, continuing the trend of a very sticky customer relationship with the product upon adoption. Unit cartridge shipments as a percentage of Model 615 shipments increased to 144% in 2014 from 125% in 2013. Cartridges as a percentage of Model 615 install base as at December 31, 2014, increased to 45%, up from 39.3% as at the end of December 2013. During 2014, Model 615 shipments increased 18% versus 2013, and replacement cartridge shipments increased 35% versus 2013. This continues to be consistent with historical trends of rising reorders as customers become more accustomed to OXYS's products. Now for a few other highlights. We entered 2015 in a remarkably strong position as an emerging medical device leader. Over the past 12 months, we expanded our international distribution footprint by adding distributors such as HTM Medical for Singapore and AJAD Medical for Saudi Arabia. During 2014 alone, we added $4.8 million in new overseas contracts. We received CE marking approval for the OXYS Model 615, a critical step toward launching the product into the 30 countries belonging to the European Economic Area. We appointed several new U.S. distributors. We made significant progress on the development of new products for the military. We launched a pilot for a cloud-based tracking and incident reporting system. We secured Cliff Meidel, two-time Olympian and Team USA Olympic flag bearer, to be spokesman and special advisor exclusively to us. We made significant staffing additions to enhance our medical device platform capability, including a VP of Resuscitation Sales, Director of Regulatory Affairs and Quality Assurance, and additions in engineering, manufacturing, and territory sales management. We opportunistically invested in operational efficiencies. And we were very excited to have been selected by the United States Patent and Trademark Office as one of 10 companies, including Caterpillar, Qualcomm, and others, to exhibit our product and technologies at the Innovation Expo held at the Smithsonian. We remain focused on enhancing our medical device platform, and this slide represents our vision for what this platform could look like. As you can see on the left, we started out with just the Model 615 and related accessories. Then we developed a full resuscitation solution, which includes AEDs, AED accessories, resuscitation products, and so forth. We are busy developing our military division, and in the future we anticipate we may end up with potentially a diagnostics division, a respiratory division, a wound care division, and so forth. At the core of these circles, we have the people we serve, the patients in the gray circle, and the caregivers in the blue circle. We serve those customers directly, but also through our distributors in the green circle. As we move forward, however, we plan to actively develop additional products and technologies, either internally or by acquisition, and the diagram on the right gives you an example of what these future divisions might look like. Also, the enlarged size of the diagram to the right indicates our commitment to growing organically all of our divisions, present and future. To illustrate further, here is a visual of some products in the resuscitation division. Besides the OXYS units, we sell backup cartridges, wall boxes, signage, AEDs, and accessories, and so forth. So we are excited about our growth strategy, and it comprises two parts. First, organic growth, whereby we expand our direct sales force and our distribution channel. We build a platform foundation with a cohesive branding and set of products. We also create the disciplines and functions needed to support a medical device company, including quality assurance, regulatory, engineering, finance, sales and marketing, a mergers and acquisitions team, and so forth. The second part comprises strategic business combination that create leverage. On top of our platform, we can then leverage sales and marketing synergies and products, and in the process, accelerate revenue. So in summary, we are now remarkably well positioned as an emerging medical device leader to achieve our goals for 2015 and beyond. These goals include rapidly growing our direct sales force, expanding overseas, launching a direct-to-consumer campaign, uplifting our companies to the New York Stock Exchange or NASDAQ, and making strategic acquisitions. We remain on track, and our stellar organic growth is expected to continue. Through both organic and inorganic approaches, we are focused primarily on pre-responder and first responder, resuscitation, emergency medical, and trauma markets. We believe we are building something special, a medical device platform company that is poised to accelerate growth in multiple ways. And that platform will allow us to make more money a whole lot faster. Ladies and gentlemen, for us, the best is yet to come. And that concludes the results portion of my prepared remarks. Thank you very much once again for taking the time to join us today. As always, this presentation, the audio file of this call, and the 10-K filing will be available on the Investor Relations section of our website. At this time, I will hand the call back to the operator for Q&A. Operator?
Thank you. We will now begin the question and answer session. If you have a question, please press star, then 1 on your touch-tone phone. If you wish to be removed from the queue, please press the pound sign or the hash key. there will be a delay before the first question is announced. If you are using a speakerphone, you may need to pick up the handset first before pressing the numbers. Please limit yourself to one question and one follow-up question. Once again, if you have a question, please press star, then 1 on your touch-tone phone. And our first question comes from Jason Napodano from Zacks Investments. Please go ahead.
Hey, Julian, how you doing?
Hi, Jason. How are you?
I'm doing well, thank you. So I guess the first question I have is, obviously you guys have been very busy with hiring territory managers and signing distribution agreements. I wonder if you could provide us any color on, where you think 2015 run rate will be, how long these people take to kind of get up and running, and what are some maybe expectations for some of the new hires that you've made?
Thanks for the question, Jason. It's a great question. We have been very clear, I think, about our intention to aggressively grow our direct sales force to complement the distribution channel. Of course, as you would have seen from the press releases, we've also increased the distribution channel quite aggressively, and we plan to continue to do so. From the standpoint of the direct sales, we intend to be at about 30 salespeople by the end of the year. We have made significant progress towards that goal. At the moment, we are running ads, for example, in about 16, 17 cities. So it's a very geographical focus. But the sales targets for these salespeople are somewhere in the 500,000 to 600,000 range per annum. So that hopefully gives you some sense of what the run rate could be as we start to fulfill these goals or achieve these goals as far as the headcount. Hopefully that answers your question.
It does. That was very helpful. I guess my follow-up will be on Europe. You've received CE mark, I believe, in the middle of 2014. I'm just wondering if you could give us an update on maybe some of the key relationships that you've got in Europe and maybe what we can expect in the EU.
Another great question. We have been active in pursuing additional distribution relationships since the CE marking process. I can tell you that some of these discussions are ongoing. We don't have anything new to announce at this time, but we expect that we will add at least a few more distribution relationships in Europe in the next 6 to 12 months or so.
All right. Congrats on all the progress you made, and future looks bright. So thanks for answering my questions.
Thank you, Jason.
And our next question comes from Thomas Pfister from Red Chip Companies. Please go ahead.
Hey, Julian. How are you doing today?
Hi, Tom. I'm great. How are you?
Good, good. My first question here is just I wanted to ask you about overall international sales. So as far as I remember, you have a number of agreements with minimum purchase agreements, and you signed $4.8 million in new contracts this past year. So how should we maybe expect the international sales to ramp in 2015?
So that's a great question, Tom. We have these agreements in place, and in some cases the agreement kicks in, or the minimum purchase sales commitment kicks in once the regulatory approval in the local jurisdiction has been accomplished. So we normally ask the distributor to pursue that. So depending on the jurisdiction, it sort of determines when that revenue stream, like I said, falls into place. With some of these jurisdictions, we are very close. In Saudi Arabia, for example, There is some administrative detail that has to take place. The main kind of regulatory approval process is behind us, and so we're excited for that to start kicking in. I know that those guys are very keen to be ready for the program season, which starts, which is in September, I believe, and so they want to be ready sometime June, July. So hopefully that gives you some color on some of these contracts in the sense of the process.
It does. Thanks, Julian. That was very helpful. And then the other, another segment I wanted to touch on was the military. So it looks like you, OXYS had a pretty good increase in military sales this year, and there's also a number of new products that you have been developing for the military. So maybe can you give us some color on how revenues should ramp with the military, and when should we expect that?
Thank you for that question, Tom. It's a very exciting area for us. The products that we've been shipping for the military to date are related to the cargo carriers and that particular application. The one that's in development right now is more of a combat use item, and we've been at it for about a year or more, and we have made considerable progress. We're excited to know that we may be doing some final testing with the military this year. So that's going to be exciting for us. It's a combat use item that would be used by the Navy SEALs and used in halo jumps and things of that nature.
Okay, great. And then just one last question for me. It relates to just the gross margin. So could you just give a little color on what the absorbed rent expense and labor cost there was, and should we expect these extra expenses going forward?
Yeah, so that's a development that is interesting. I mean, we have, in conjunction with our auditors, decided that the most appropriate way to deal with this is to fully burden our cost of goods sold with all the direct labor costs associated in manufacturing, and a full portion of the rent related to the space that is dedicated to manufacturing. Now, what that does is, as the sales grow, the margin actually tends to increase because it tends to be more of a fixed cost versus the number of units that you ship, if that makes sense.
Yes, absolutely. That definitely does, Julian, and thank you for clearing that up for me. That's all the questions I have for today, so thank you again for all the color. It's been very helpful.
Thanks, Tom, and thanks for joining us.
Our next question comes from Dan Tran from Stonegate Capital. Please go ahead.
Hi, Julian. Thank you for taking my question. How much of the growth that you talked about for the top line has been from Estil and from OXYS, respectively?
So Dan, thank you for the question. Just to clarify, we did not close the Estil transaction in 2014.
Okay.
We filed an 8K in this respect. So at this time, that's really all I can say about that.
Okay. Is it still in the works by chance?
As I said, at this time,
okay.
I'm really not able to comment on that, unfortunately.
Okay. And regarding your strategic acquisitions, what are you looking at as far as some of the traits you're looking at in regards to strategic acquisitions? What are you looking for?
We're looking for synergies in different areas, especially product, customer. If the call points are the same, then it's very attractive to us. But we remain focused in the emergency preparedness, resuscitation, trauma space, first response markets, pre-responder markets. That's sort of our sandbox, if you will. And so we've been looking at companies that are either AED companies or respiratory companies, first aid supplies, and so forth.
Okay. Thank you.
Thank you, Dan.
Our next question comes from John Freeman from West Coast Rap. Please go ahead.
Hey, good morning, Julian. My question has to do with the fact that initially our stock was handled by World Trade Financial Corporation in San Diego, who then transferred it to a holding company in Nebraska. World Trade Financial Corporation has ceased to exist, and the clearing company has sent me a letter requesting that I transfer my account to another brokerage firm. Could you give me a suggested brokerage firm, or is that outside of your jurisdiction?
It really is, John. Of course, I would get in trouble if I start recommending brokerages. However, I do know that some of our other investors have had fairly good luck with some of the brokerages. So in that sense, we can sort of say, here's a list of brokerages that we know other investors have been successful with, and then you could perhaps select from there, if that makes sense.
That makes good sense. Shall I give you my address, for mailing address for that list?
Yes, sir. I think if maybe we do that offline.
Yeah, Julian, this is John Cunningham. John, if Julian, we can get his contact info from the participant list, and John, we can help you in the matters regarding a broker.
Okay, thank you very much.
Thank you, John.
And our last question comes from Mike Briard from Hodges Capital. Please go ahead.
Good morning. I've seen some of your product advertisements on TV. Have you been able to trace the response from those advertisements?
Yes, Mike. We have been able to trace the response has been very good. Now, the ads that we've been running are somewhat, there's a duality in purpose there. It's partially to raise awareness about the product and our technology, but also it's partially kind of an outreach to the investor community. So in that sense, we have been tracking the results very closely. It's not just the TV ads. We've been doing kind of an integrated campaign, so it's TV, online. We do the Google AdWords, all those different elements together. And so, but yes, the response has been phenomenal.
Okay, good. And then one last question. What kind of progress are you making on getting your stock uplisted to a better trading platform?
We've made considerable progress. We've hired an investment banker up in New York. They are actively working on it now. There are a few elements that have to be in place, as you know, some housekeeping, things like some of these things are basic things like you have to have your audit committee in place and so on and so forth. So a lot of that work has been done or is in progress. So we look forward to giving you guys an update on that in the very near future.
Okay, thank you.
Thank you, Mike.
I will now turn the call over to Julian Ross for closing comments.
Thank you, operator. Well, and that wraps up our call for today. On behalf of the board of OXYS and myself, thank you very much for participating today, and thank you for your continued support. Have a great rest of the week, and you will hear from us again soon.
Thank you, ladies and gentlemen. This concludes today's conference. Thank you for participating. You may now disconnect.